Hello, everyone. Welcome to the Financial Mini Lecture. Perhaps some of you noticed that in March 2024, the Agricultural Bank of China issued a batch of 3-month negotiable certificates of deposit for corporate and individual investors, with an annualized yield of 2.25%. This type of short-term financial product issued by banks and freely transferable is one of the key instruments in the money market. Today, we will use this type of money market activity as our starting point to learn about the concept and structure of the money market. The money market, simply put, refers to a market where short-term financing is conducted through financial instruments with maturities of 1 year or less. There are 2 core points you must remember. 1. Maturity characteristic. Instruments must have maturities of 1 year or less. For example, the 3-month negotiable certificate of deposit issued by the Agricultural Bank of China meets this requirement. This is the essential difference between the money market and the capital market, which uses long-term bonds and stocks as instruments. 2. Functional positioning. It mainly addresses short-term funding needs and short-term investment needs. It not only helps fundraisers such as governments, banks, and enterprises broaden their short-term financing channels, but also provides flexible value-added options for the idle funds of investors, including banks, enterprises, and individuals. From the perspective of participants, the money market includes a wide range of entities such as central banks, commercial banks, enterprises, securities firms, and individual investors. For example, commercial banks issue negotiable certificates of deposit to absorb short-term funds, governments issue treasury bills to raise short-term fiscal funds, and individuals can participate by subscribing to certificates of deposit or money market funds. The money market is not a single market. Instead, it is an organic system composed of several submarkets, each serving different financing functions. The main components include the following. 1. Interbank lending market. The interbank lending market is where financial institutions lend short-term funds to one another. The typical maturity ranges from 1 to 7 days, with the shortest being only a few hours. Overnight lending is the most active segment. Its core function is to help commercial banks fill short-term funding gaps and adjust liquidity, ensuring stable daily operations of financial institutions. 2. Commercial paper market. The commercial paper market takes commercial bills as its trading instruments. Commercial bills mainly include commercial drafts and bankers' acceptances. Enterprises can raise short-term funds by issuing commercial papers, while investors earn returns by purchasing them. This market is known for its simple procedures and relatively low financing costs. 3. Treasury bill market. Treasury bills are short-term government bonds issued by the central government, typically with maturities of 3 months, 6 months, or 1 year. Because they are backed by the credit of the central government, Treasury bills are considered one of the lowest-risk financial instruments and are often referred to as risk-free assets. They are not only an important channel for governments to raise short-term funds but also a preferred short-term investment option for individuals and institutions. 4. Repurchase agreement market. A repurchase agreement refers to a transaction in which both parties agree that the seller will repurchase the same securities at a predetermined price on a future date. In simple terms, for the bondholder, It means selling the bond now to obtain funds and buying it back later at an agreed price. The essence of a repurchase agreement is a secured short-term financing method. This market is highly flexible, with maturities ranging from very short to relatively long, and it is an important venue for financial institutions to manage liquidity. 5. Negotiable Certificate of Deposit Market. The negotiable certificate of deposit market is where banks issue and investors trade a special type of deposit certificate. The core product of this market is the negotiable certificate of deposit, commonly known as certificates of deposit. A negotiable certificate of deposit is a fixed denomination, fixed maturity, transferable deposit certificate issued by commercial banks. We can break it down as follows. Large denomination. The minimum amount is high, mainly targeting institutional investors and high net worth individuals. For example, in China's interbank market, the minimum for individuals is typically 200,000 Chinese yuan and for institutions 10 million Chinese yuan. Negotiable. This is the key difference from ordinary time deposits. Holders cannot withdraw early from the bank before maturity, but they can sell the certificate of deposit in the secondary market like trading stocks, thereby converting it into cash. Time deposit nature. Certificates of deposit have fixed maturities, usually from 1 month to 1 year. Deposit certificate. Essentially a liability of the bank and a form of deposit protected by deposit insurance, within the insured limit. Like the stock market, the certificate of deposit market also has 2 levels. Issuance market, primary market. In this market, banks issue new certificates of deposit directly to initial investors to raise funds. This is mainly through underwriting syndicates, either on a firm commitment basis or on a best efforts basis. Trading market, secondary market. This is where investors trade certificates of deposit that have already been issued but have not yet matured. The existence of the secondary market gives certificates of deposit their negotiable nature and ensures liquidity. This market is dominated by securities firms, money market funds, other banks, enterprises, and other institutional investors. The negotiable certificate of deposit market is a crucial sub-market within the money market. Through the design of negotiability, it combines the high yield of time deposits with the high liquidity of demand deposits, perfectly meeting the needs of both banks and investors. It is a classic example of financial innovation. Next, let's review what we learned today. The money market is the core venue for short-term financing, with maturities of 1 year or less as its defining feature. It consists of several sub-markets, including the interbank lending market, commercial paper market, treasury bill market, repurchase agreement market, and negotiable certificate of deposit market. Each sub-market has its own financing functions and participants. Understanding the structure of the money market helps us master fundamental financial knowledge and better understand the operational logic of financial markets in our future work and daily life. I hope you will further reflect on the relationship between central bank monetary policy and the various submarkets of the money market to deepen your understanding. Thank you all. See you next time.